U.S. stocks staged their third straight rally today. In fact, we closed near the highs of the session on most of the indices. We were led higher by the Russell 2000, which was up just over 1%. The other indices didn't quite get there, but still a pretty decent day across the board. In fact, good enough for us to have weekly bullish postures from an intermediate perspective using that market forecast technical indicator once again. The problem is we still continue to have lots of falling 30-day moving averages as well, and it's not like the sellers have just gone away. They might have been in hiding for the last 3 days, but there's a pretty decent chance they're going to reassert themselves here again within coming weeks if we do see continued progress to the upside. So be on the lookout for that possibility. But in tonight's video, wanted to look at some of the areas like cryptocurrency, wanted to look at sectors and show you just how much oil and gas companies have been outperforming other types of companies. And then last but not least, I wanted to also focus on a neutral trading strategy. We've been doing a lot more bullish trading strategies lately, but with this nice rebound we've had, I'm kind of cooling my jets there a little bit. We're going to concentrate on an iron condor, which would benefit if this particular stock in question would continue to go sideways between now and the middle of March. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's February 1st, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these free YouTube videos. In addition to that, we also will let you know which stocks, if any, within the S&P 500 are giving you overbought and oversold cluster signals at the bottom of those emails. We're also heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. Thanks for those of you that were reporting my imposter yesterday as well. I appreciate that. It's the fourth time that's happened, but you guys are usually on top of it, and thanks for letting me know and for getting that all squared away with Twitter as well. We don't want those imposters running around out there, but make sure you're following me. The guy or the gal, who knows, did it the other day, just spelled my name but with one of the E's missing at the end. So just verify that it's at Brandon Van Zee, 2 E's at the end, that you're following. It should be. And we really appreciate those of you that click like and retweet on these Market Outlook related tweets. And then last but not least, we have a presence over on Facebook as well. Feel free to check out our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. It was a pretty good day, and a reminder, I try to bring this up fairly regularly in these presentations and in my classes that I teach over at Market Scholars. Remember, the first trading day of the month tends to be a bullish one, all else being equal. Obviously, we're in a little bit more precarious times here so far in 2022, but that's just a little tidbit and a nugget that you can put away for future reference, that if you were to go back throughout history, you'd be amazed by how much of the market's total return through history is as a direct result of day number one of every single month. Now, obviously, you can't bet the farm on something like that because there will be some first days of the months that are going to be down here and there. But in general, if you're kind of sitting on the fence on the final trading day of the prior month and you're not sure if you should be bullish or bearish the next day, it does land bullish more times than not. And you can see here with our heat grid or our heat map on the S&P 500, that we have a lot more green than red, which is a nice thing. You can see some of the bigger winners today. We actually talked about UPS a bit earlier in my classes today. UPS is a stock that we've purchased many times throughout my dividend classes, both at Invest Tools by TD Ameritrade when I used to teach over there, and then also here at Market Scholars. That was the best performer in the S&P 500 today. It was up 14%. So you saw me tweeting about their dividend increase announcement today. It's a big part of the reason the stock was up so much. They increased their dividend by 49% today, which is just truly extraordinary. So kudos to the management team over at UPS, and congratulations to any of you who might own it. Other big winners here today: Exxon Mobil. Speaking of well-known dividend growth companies, Exxon, of course, one of those dividend aristocrat companies that's been a bit out of favor in recent years with oil prices struggling, but of course things have changed pretty dramatically in the last few months as oil prices have surged higher. Many of the oil stocks have followed suit. Today, Exxon was up 6.4%. Chevron was up 2.6%. Conoco was up 3.5%. So some big movers there in the oil patch. You also saw Netflix have a nice rebound here today, up 7%. That stock has been incredibly volatile recently. That particular stock was down significantly off of their earnings announcement a week or two ago, but then also had the benefit of having their CEO buy a bunch of shares as an insider transaction, and then also had some benefit from some hedge funds and active management teams and things like that. So I think Bill Ackman was part of that here news cycle last week, getting involved in Netflix. So they've had a pretty nice rebound since the worst part of the drop after their earnings announcements. That was another big mover today. Boeing was a pretty big mover today as well. It was up 4%. We're actually going to be talking about that stock a bit later. And then also take a look at the consistency within the financials. Almost all of the financials were up today. Not all of them, but most of them they're listed in the green. We did concentrate on the financials as part of my head-to-head matchup in my dividend growth investing class today, where we finally got a chance to buy a stock that we haven't had an opportunity to buy in the last couple of years, but one that we do consider to be quite high quality. Wells Fargo, you can see, was up 3.5%, so that was one of the brighter squares there within the financial space. But you can see some of the others. Citigroup did pretty well, was up over 2% today as well. SIVB was up 3.7%. Fifth Third was up nearly 3%. So there's a handful of those companies that were up, right around that 3% level here today. We also saw some pretty good activity from some of the bigger communication stocks, I guess you would call them, with Meta/Facebook being up 1.8%, and then Alphabet being up 1.7%. However, that's not the real story. The real story is what's happening after hours with Alphabet. Now, we happen to own Alphabet as one of our coffee can stocks in my Monday top-down trend trading class. And a coffee can stock for us in that particular class means that once we've doubled our money in a stock, we sell half of our shares, extracting our original cost basis, and then let the remaining shares run, kind of playing with the house's money, as it were. And so it hasn't been particularly fun watching the downdraft in stocks like Alphabet in the last few weeks and other growth stocks. But good news after the bell tonight. Alphabet did report a 20-for-1 stock split, as some of you might have seen me mentioning there on Twitter here just a moment ago. So the stock is up tremendously. It's up about 7 or 8% after hours, and that will take that approximately $3,000 stock after hours and make it about a $150 stock whenever that stock split takes place. And so however many shares you might own in your own account, take that times 20, and that's how many you will own after the fact. So the market seems to be very much applauding that. Of course, they reported earnings as well, but there is some speculation perhaps that Alphabet is doing that to maybe make it more eligible for the Dow Jones Industrial Average. Remember, several years ago, Apple had to go through its own, I think it was a 7-for-1 split at that time, in order to make their share price lower and more digestible and make it more eligible for the Dow Jones. So don't be surprised at all if at some point in the next year or two we hear an announcement that that Alphabet is entering into the Dow Jones 30. In terms of poorer performers, you can see AT&T was one of the worst performers in the S&P 500 today. It was down 4%. They did formally announce their dividend decrease today. Now remember, for those of you that are keeping up with the news within the dividend world, as I tend to do and try to share with my students, that should not be new information. What is new is we know officially how much they are reducing the dividend by, which is about 50%. That's all associated with that big reorganization that they announced back in May, where they are basically taking Discovery Communications, and then they're going to lop off Warner Media, combine those two companies, and then spin it off to AT&T shareholders, and then also reduce the dividend as part of that transaction. So it's a big, complicated deal, but they've already announced last May that they were planning to cut the dividend. So it's just a matter of confirmation officially here today. Remember what I mentioned to you guys in this presentation last week when I posted the Dividend Aristocrat list, that AT&T was already kicked out of the Dividend Aristocrat list last week. So anyway, today is the official confirmation of what they've kind of been headlining over the past year already. And that stock did take a tumble here today on that news, and their compadres there in Discovery Communications was down about 2.6% today as well. Tesla was down a bit today. It was down 0.58%, but that's not a big deal compared to how that stock usually trades. You did have a couple of these bigger tech stocks, Microsoft and Apple, down just a touch today as well. I don't want to make a big deal out of those because they were basically flatline, but because they're bigger companies that do have more influence on the market, it's just helpful for you to know what was kind of moving within the markets here today. Now, speaking of earnings announcements, I mentioned Google was moving higher after the bell by about 7 or 8%. We also have AMD moving nicely higher after the bell today. They were up about 2% in the real session, but they're up a lot more than that after hours on their earnings announcement. On the flip side, unfortunately, Starbucks is down about 4% here as we speak. I say unfortunately because that is one that we've had in my dividend growth investing account. So, it's had quite a run over the years, but given some back after hours today on some China weakness. And then another one that's down tremendously is PayPal. That's not one that my classes have an association with, but it is down significantly after hours. PayPal was up 2% in the normal session, but the last I checked, it was down about 15% after hours today on that earnings announcement. So kind of makes this time of year a little bit more fun, a lot more dividend announcements, a lot more earnings announcements to make stocks go all over the place and give us something to talk about there. But in general, the takeaway from today's session, as you can see, mostly green on the first trading day of the month, which is oftentimes the case, and we continued our kind of dead cat bounce, if you want to call it that. Remember, we've been waiting for a bullish bounce. I think both David and I have been mentioning that for a few weeks now. In fact, most of our trades we've been doing lately, at least mine in this presentation, have been bullish in anticipation of this bounce. So the bounce is not surprising. The real question is where it takes us. The fear that I have is that it's going to roll over as we approach the falling 30-day moving average on the major market indices. But I'd be happy to be proven wrong on that count because I'd rather have the stock market go higher. But that's one thing that you just have to be on the lookout for if you are a more active trader is, yes, it's fun to see these bullish days to the upside, but let's try to keep our cool heads about us. Remind ourselves that there has been some broken trends out there, broken charts, and all else being equal, you want to make sure you respect those trends. And right now, the trends are still to the downside until proven otherwise. And they'll have that opportunity to prove it otherwise. It's just that we haven't seen those breakouts above the moving averages quite yet. Speaking of which, let's go ahead and take a look at our 4 grid now and look at those moving averages. So here is the 4 grid for the 4 major U.S. equity indices. A reminder for those of you that might be newer. The background colors on these charts will tell us whether the posture is bullish or bearish. And when I say the posture, I'm referencing the green line, which we also call the intermediate line on the market forecast technical indicator. And so we have some good news to share on that front. Today, the Russell 2000 finally kind of followed suit with the other 3 indices and turned to a weekly bullish posture. Right? Yesterday it was still bearish. Today we had just enough to get that green line out of the lower reversal zone there on the market forecast. Remember, the lower reversal zone on the market forecast is at 20. And so you can see in the label here, it says the intermediate line is at 20.61. So in other words, just barely got out of the lower reversal zone. And therefore, if there is a big down day tomorrow for some reason, don't be surprised at all if it quickly went back to a bearish posture very, very soon, because you're basically just right there on the brink of being either strongly bearish or weakly bullish. So right now, that is the case for all 4 of these charts, weekly bullish postures. That sounds like it's a good thing, but again, my concern is look at where each one of these charts are positioned versus their 30-day moving average. In all of the cases, the indices are still trading below their moving averages. In fact, in all of the cases except for the Dow Jones Industrial Average, they're trading below their falling 30-day moving averages, which makes it even worse. With the Dow being the exception there, you can see that the moving average on the Dow is yellow as opposed to red like we see with these other charts. And what that signifies in this particular case is that the moving average is rising just barely, even though price is still below it. So that yellow, you can kind of think of it at, the way that you would read a stoplight. Yellow would be kind of yield, where it's telling us, different things. When it's red, like it is down below here on the moving average for the Russell 2000, it's saying those two things are in confirmation with one another. The moving average is moving lower and price is below it. When it's green, like it would have been up here with the Dow, it's telling us those two things are in confirmation with one another bullishly. Price is above a rising moving average. But when you have a yellow moving average, it's telling us that those two things are in conflict with one another right now, and we're still trying to determine, what that means, and it's time for, maybe some caution. So that's the good news if you're looking for it. We should always do our best to read the charts and react accordingly. But if you're hoping out there, hope's usually a difficult strategy for a trader. It can be a better strategy for an investor, but trading's a different story when you're active with your money. Hoping for one thing to happen can be a challenge. And so right now we just have to be mindful of the fact that we still have a difficult market environment despite what the last 3 days have told us. Last 3 days are basically just burning off the fat of what has been a really ugly decline. Remember, I don't have any bearish trades going in the market outlook videos right now. In fact, I was looking at the account holdings here a moment ago, and I was pleasantly surprised because all of my trades that I've done for you guys in the last month or two that are still open right now, every single one of them is profitable, and not a single one of them is a bearish trade. So that should tell you something about how I kind of think about markets, where when we got into these really nasty sell-off periods here recently, I want to take the other side of that trade. Now, in my trade application example later in tonight's video, you'll see that it's going to be an iron condor. Some of you already know that because you received my Telegram notification about it earlier today, but you can kind of read between the lines there a little bit that if I've been doing a lot of bullish trades in the last couple of weeks in the anticipation of this rebound that we are now experiencing right in front of us with these last 3 days, and now I'm starting to do an iron condor, my ambition there, my boldness is starting to dissipate a little bit. In other words, we've had a nice rebound. Now the question is how much more is in the gas tank, right? And my fear is that we probably don't have a tremendous amount more to the upside before the sellers step in again. And so we're not quite there yet, right? A lot of times I look at the moving averages themselves. You can see we still have an air pocket between, let's say, the S&P 500 where it's trading right now and that falling 30-day moving average. In other words, would it surprise me if we go up another day or two and start, bumping our head on the underside of that moving average? No, not at all. Which is why I'm not doing an all-out bearish trade here tonight. That could happen, right? You never know. You've just got to do your best to, trade what you see. And what I'm seeing right now is that we've got some decent short-term bullish momentum heading towards that potential resistance area, which at this moment in time, until I find other information, I'm going to assume that is going to result in selling. We're not there yet, so I don't want to get ambitious and do an all-out bearish trade here. So I'm doing an iron condor where you can have more of a neutral mindset where you do benefit if it kind of rolls over. And again, I don't want to get ahead of myself. We'll talk about that specific trade later, but I'm just trying to let you guys know what's in my head and why I've been doing the bullish trades in the last couple of weeks in anticipation of this 3-day bounce that we're receiving now. Now that we've received it, I think we've probably gotten more than we probably deserve in this 3-day bounce. We have a little bit left in the tank, but I'm not expecting us to immediately go back to new highs and then, life is grand and we're all off enjoying ourselves with brand new uptrends across the board. I think there's going to be more of a struggle here before we get to that moment. We might get to that moment later this year, maybe in the summer or what have you, but I think here in the intermediate term, I don't think the bears have gone away quite yet, so I think we have to all be prepared for that possibility. Anyway, S&P 500 was up 0.69% here today. And so, that was a pretty decent day for it, particularly considering the back-to-back up sessions that we had on Friday and Monday, closing basically at their highs. And again, we were nearly able to do that again today. So today, you'll notice that our range was not aggressive. Notice the colors of the labels up at the top. I discussed this with you guys last week as well. But at that time, I was discussing how they were all orange. And remember, when those labels are orange, it tells us that the daily range is wider than the average true range. Today, it's telling us the opposite. Today was a relatively quiet day. It probably doesn't seem like it compared to some of the days that we experienced last year when the biggest pullback we got the entire year was 5%. There was a lot of stretches of last year where these would have been considered pretty decent days, where we're up, 1% on the Russell and nearly 1% on some of these other indices. But this is actually considered a quiet day considering the extreme volatility that we've been dealing with more recently. So when all those labels are blue, that's another reminder that things have cooled off a little bit, and not necessarily a great sign at the kind of tail end of this 3-day move here either, because it gives you the impression that the bulls were the most ambitious the first 2 days, and they're still somewhat ambitious on this third day here, but their enthusiasm has kind of worn off just a little bit there. So that's another sign where you're kind of expecting more of a head-to-head battle between bulls and bears here in coming days, as opposed to this one just being all for the bulls for the last 3 sessions. In terms of the Dow, it was up 0.78% today. So it was actually the second best performer behind the Russell 2000, which is a little bit surprising to me. Usually on these big up days like we have here, where you've got the Russell up over 1%, you would expect another more aggressive index to be kind of the next best. So I would have, without knowing otherwise, guessed that this NASDAQ would have been second today. It was close, so I don't want to make a big deal out of it, right? It was NASDAQ was still up 0.75, so it was just barely 3 basis points below what the Dow did. But the NASDAQ's results did not surprise me. The fact that the Dow could be the second best today was a little bit surprising. And it just shows you that the blue chips still have some interest even in these market rebound days. It's not surprising when the Dow is the leader when the rest of the market is falling, but the fact that it was kind of in second place today on a aggressively or widely bullish up day is rather impressive. Remember what I've been mentioning to you guys for the last month or two at this point, which is it is my impression that the Dow is this current market's leader. We know that through a variety of ways, but one of the more obvious ways to recognize that when we're looking at this foregrid is just simply looking at the intermediate line reading, and you can see it's at 41 right now, which is higher than the S&P 500 at 35, which is higher than the NASDAQ at 27, and which is higher than the Russell 2000 at basically 21. And so pretty impressive to see the Dow do as well as it did here today. Part of that might have been, JP Morgan and some of those financials that I had mentioned doing pretty well there for that particular index. In terms of the bottom two, I mentioned NASDAQ was up 0.75%, and then the Russell was up 1.1%. So the Russell was our leader today. S&P 500 was our laggard at only up 0.69%. All of these indices now have weekly bullish postures. The Russell's is very precarious, so it could easily go back to bearish tomorrow if there is a sell-off tomorrow. And then all of these will have some important work to do in front of it in terms of when its price candles start to interact with those downtrending 30-day moving averages. And my mindset right now, until proven otherwise, is that they'll probably roll over at those moments, unfortunately. And at that time, there might be opportunities for more bearish trades. In terms of 3 green arrows status, let's take a quick look at that chart as well. And that will be chart 4D for those of you that are premium market scholars following along at home. Here we have kind of mixed results across the board. You will notice that none of these charts have 3 red arrows. None of them have 3 green arrows. All 4 of them have a mixture of green and red arrows at this moment in time. In fact, all of them have the exact same kind of setup. In other words, all 4 of the charts are closing below their moving averages. So the red arrows on the moving averages are all in place. But all 4 of the charts also have green arrows on their MACD histogram and their stochastic down below. So each one of these charts is set up somewhat similarly, where there's 2 green arrows and 1 red arrow. And so they would need to get up and over those moving averages if they thought that 3 green arrows was in their future. But we've got some work to do there. The first one that'll likely happen, if that happens, will be the Dow Jones Industrial Average. Again, it is our leader in this current moment in time. It's also the one that's closest to the 30-day moving average, as you can see up here. So if the Dow had a big, let's say, 1 or 2% update tomorrow, it would have 3 green arrows all of a sudden. But let's not count our chickens before they're hatched. There's work to do. Let's go ahead and pop on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support these presentations. The last time I did the video, 115 of you came out of the woodwork to click like there for me. You can see my Rams helmet in the background. Assisted my team this weekend in a thrilling victory over the 49ers. Very much looking forward to Cincinnati versus Los Angeles in the Super Bowl. Probably not the most enthusiastic Super Bowl for non-supporters of those teams, but for the Bengals fans and the Rams fans out there, we don't have a whole lot of Super Bowl victories in our history, so we're excited to play one another and really happy to see the team prevail when it counted the most there. But anyway, I appreciate the 115 of you that clicked like for me there last time around. Some of those friendly folks, John and Bill and Robert and Fun Jonesy and Analysts of Wall Street and DGI and Options and Billy and Barry and Susan and Carl and Ron and Warren and Ken and Irene and Valerie and John and Dale and Michael and Dave and Yair and Ed and SW, Rishav, Jayesh, and Paul and others. Too many to report, too many to mention, but I really appreciate that, right? These videos take over 3 hours of our time to do. I know that sounds probably crazy to some of you. We don't make a single cent off of them, but it actually does take that long. It takes that long to do the research, do the prep work, place the trades, send out the notifications on the trades, do all the video uploads, the edits, the rendering, send out all the notifications, write the paragraph. Believe me, there's an endless amount of things that go into what seems on the surface to be a very simple video. So we really appreciate those of you that are willing to trade your 5 seconds of your day by clicking like for us there on Twitter for our 3 hours that we put into this effort each trading day. Anytime we're up and over 100 likes on Twitter, I'm happy to do a full-length video there for you, which includes a trade application example. And as I mentioned to you a moment ago, all of my trade application examples here in the last month or two have been profitable as of this moment in time. Alibaba finally got it together here the last couple of days. Not up much on that one. I wish I'd have waited a week to place that particular trade, but we're back above break even, so I'll take what I can get from that count. So I always figure you guys probably learn better when there's a full-length video and a trade application example on the end, especially when they're winning trades, as I'm assuming you like those, as opposed to the losing ones, which we'll have plenty of those as well. But at least it gives you a chance to learn through application. If you don't care about the trade application, you only want a review of the indices, don't click like on Twitter. If we're under 100, then I'll just do a quick hitter 15-minute video and we'll be done with it. But for those of you that prefer a deeper opportunity to learn, then that's your way to go about that process of thanking David and I each day. Just click like for us there on Twitter. Thank you so much for that. Also, let's go ahead and pop on over here to our website briefly. Wanted to bring up the Sector Selector tool as well, which you can find under the Premium Tools tab, of course, if you are a premium member. And on the Sector Selector, you'll notice there wasn't a whole lot of change this time around, right? We've had a tremendous amount of change. You can see kind of in this area, end of December, beginning of January, there was change all over the place. In fact, that was some of the most aggressive changes we've ever seen. I think one of those weeks I was mentioning how every single position, 1 through 11, had a change, or at least 10 out of the 11 did. This week we didn't really see much in the way of change. What we did see was somewhat noteworthy in that information technology fell to the bottom position. Now, when I went back in my notes, that has not happened in 4 years. at least 4 years. It might even be longer than that. I used to have a tool that was similar to this called the top-down thermometer when I used to work at TD Ameritrade, and I don't have my notes from that time period, but I can tell you, since I've been collecting the data here at Market Scholars, this is the first time in 4 years that information technology has been dead last on the sector selector. And I'm nearly certain that's the only sector up until this point that had not been dead last at least 1 week along the way. Technology was second to last on 1 week a few years ago, but they've never been last, which is crazy to think about. They have been consistently strong compared to so many other sectors out there for such a long period of time that it's almost unfathomable that technology could be so out of favor, but that is where we're at right now. I did mention a week or two ago as well to keep your eye on communication services, because they had been out of favor for a long period of time. But one thing that I had noticed myself when going over a bunch of charts one weekend is how there were a lot of the old school communications companies that were starting to bounce. You know, stocks like Viacom and Verizon and some of those types of companies, right? A lot of times people think of Alphabet and Netflix and Meta as the communication stocks. And that's true. They get all the headlines. They're the exciting internet companies. But there's a whole bunch of cable companies and, boring other telecom companies that we oftentimes don't think about. And a lot of those old school ones did turn. In fact, we had that conversation in my top-down trend trading class on Monday. For those of you that are premium members, feel free to check out the recording there. But I was showing folks in that class how there was a bunch of foreign telecom stocks that were starting to make really nice moves on our stock selector tool. And so, that's kind of an interesting side element of this week's ranking, is that finally communications is off of the bottom slot. And you can see they were dead last since going all the way back here to mid-November. So that is a bit of a change there. But the big takeaway is technology and growth stocks in general have been so out of favor over this last month and a half or so that we now see tech dead last. Now, I imagine they'll probably have a pretty decent chance to bounce this week, so I don't know if they'll stay dead last, but the fact that they were there at all is almost remarkable, just considering they had not been there for 4 whole years. Obviously, energy remains number one. This is really a market where it's energy and everybody else. I mean, second place is consumer staples because something has to be there, right? This is all based on a relative ranking system. And by the way, this is an equal weighted approach. So it's not like the market cap weighted approach that you're used to where, something like Tesla has a massive influence on something like discretionary. These are all equal weighted. But it's kind of remarkable where we're at right now with energy being so far in the lead at number one. Number two is, miles away. So it's like energy that's doing really well on an absolute basis right now, and then everybody else is just kind of vying for the scraps there behind energy. All right, let's get back on track with some more Thinkorswim charts. Popping on over here now to the, let's do some 12 grid analysis. So let's start with 5A. This will be the asset class 12 grid. And by the way, going back to the comment I was making about the Twitter likes, again, I really do appreciate that. You guys have done a remarkable job. In fact, I think we went the entire month of January where you guys were above 100 likes every single time on my videos. So good job there. Whoever you core 100 are, keep it up, because as long as you guys keep doing it, you're kind of subsidizing everybody else, whether they're willing to do it or not. But if you core of 100 plus that have done that each time for me in January can continue to do that, we'll continue to get these full-length videos. So again, really appreciate that. That's one simple way that David and I can hopefully promote our business. As you can imagine, being a 2-person operation, we don't have a massive marketing budget or anything like that. So social media is our way to get the word out about our business, and you guys do a great job of assisting us with that. So thank you very, very much for that. Anyway, here we are on chart 5A, and this is our asset class 12 grid. This is going to show us a lot of different things. We've been talking mostly about the stock market thus far, but remember this 12 grid here is going to kind of get into a lot of different areas. For instance, Bitcoin, right? I mentioned 1 week ago that I thought Bitcoin was an interesting place to take a speculative bet to the upside because I've shown you the 6-month chart and how we were approaching those lows from back in June. It's done pretty nicely in the last week or so. it's gone up about, I don't know, 12, 13% since that particular time period. The problem is it had been so out of favor in such an aggressive fashion that despite this, 10 to 15% move from the lows that we've had about a week ago, Bitcoin continues to be in a downtrend and continues to have a strongly bearish posture. So again, I think of it as a speculative, bombed out position that could have some interesting appeal to the upside for speculation purely. But if you're trying to trade it as a trend, obviously you'd be jumping the gun at this moment in time because it's still not in an uptrend. It would have to get above the moving average before you even start having that conversation. So you're probably at a pretty important level here on Bitcoin right now as to whether that could potentially be in the cards. You'll notice that there were several other times, like from here to here to here to here to here to here, and now again here to here, where you had about, let's call it a week or a week and a half of reprieve from the selling that eventually resulted in further selling. And so you're kind of at that moment in time here, about a week or a week and a half into this kind of slight bounce that we've had before we see, whether this thing has the mettle or not to survive it this time around. In the past, the sellers have taken hold. This time remains to be seen. We had a little bit of a doji type of a candle here today. So talking about a little bit of indecision, it was up a little bit. Bitcoin's currently at about 38,000, but we do have an indecision day. So this would be an opportunity for the sellers if they wanted to push this lower again, just like they've done several times in the past. But I do think we're sniffing around that territory where Bitcoin is kind of probing for a more serious bottom around these levels. It's just that they've got work to do because the sellers have truly controlled the price action here for several months at this point, and so it's going to take a pretty strong effort from the bulls to accomplish that. But I think it can be done. Just going back to what I'd mentioned a week ago, if we went to the 6-month chart, let's see if that still shows up. Actually, let's go to a 1-year chart since we've advanced it another week here. This will show it a little bit better. This is that area that I was mentioning back in June and July of last year where you kind of bottomed out at this territory. And we basically probed that area just a little bit on that big downdraft last Monday. Been rising since then. But, would it be out of question to see it roll over again, test that area again? No, it wouldn't be out of question, but I do think that there's a legitimate chance that the bulls do step in a more earnest way at around those particular levels right there. And I think that's around I want to say 30,000 on Bitcoin, somewhere around that general vicinity. In terms of other charts on the asset class 12 grid here, you will see that interest rates were up a touch here today. So we closed on the 10-year at 1.8. Remember, interest rates have been in an uptrend. We do have a bullish trade going on TLT. It is one of my winning trades right now, believe it or not. It was a bullish trade on TLT, but the structure of the trade was correct, and we did it at a time when TLT was really getting bombed out. Remember, what we need for that particular trade is for us to stay above 139. We're at 141.72 right now, so we're in reasonably good shape, but I don't think the story is fully written yet, right? We can't do any victory laps quite yet because we still have another couple weeks to be in that bull put spread, and we are still in a downtrend, right? If you had to look at this, you could say that yes, the selling got too extreme and we were destined to kind of cool off on that selling, and that has been what has happened in the last month or so, but this is still clearly a falling 30-day moving average. Price is still below it. We still have a strongly bearish posture. So it's a little more precarious, I guess, is the point that I'm trying to make. So I'm happy that we're sitting on profits right now, but it is certainly possible that those could be eroded if we're in the wrong type of a market for the next couple weeks as we go into the February expiration cycle there. So that was one of the spread trades that we had done. Remember, a lot of my other trades that we've been making money on lately in these videos have not been spread trades. I think there was another one, CF Corp, that was a bull put spread as well that we're making money on because that one did reasonably well the last couple of days. But most of my other ones have been selling puts, right? Doing things like, selling puts on Best Buy and Corning and PetMeds Express and T. Rowe Price and Texas Instruments. And, I was doing those into the worst part of the selling. And so, there are areas where I felt like selling puts last week was nearly perfect conditions, ideal conditions for put selling. Again, we had that conversation, so I don't want to, take it too far. We had the conversation on Thursday where I was saying, I know some of you might disagree with me. Some people would say when the markets are bearish, you shouldn't be doing bullish things. But to me, those are perfect opportunities for kind of sifting through the rubble on high quality merchandise. Remember, I'm not suggesting selling puts on junky merchandise in market sell-offs. I'm suggesting that a lot of times babies get thrown out with the bathwater, and as long as you're doing your best to focus on quality of businesses, particularly through the approach that I teach using the dividend stair-step chart, that you can afford to be brave when everybody else is nervous. And part of the reason that works is because volatility is quite high when everybody else is nervous. And so you're getting kind of an embedded benefit by selling highly juiced premium when you could be selling puts on those exact same companies in non-volatile environments, and you wouldn't get nearly the good benefit that you do when you're doing it when everybody is afraid. So will it work every time? Of course not. Whenever we do have a prolonged bear market and a really, really difficult nosedive in the market, whenever that happens in the future, put selling could stumble. But right now, we do have a 2-year win streak in my put selling, and that stretches over 100 trades. So it's not like we just sporadically do them. We're talking about over 100 trades in a row that we've won for put selling specifically in both this presentation here and in my Options for Long-Term Investors class that I teach on Monday afternoons, where that class's sole focus is on selling puts. It's just a minor focus of these videos when I think the conditions are good, as I have thought they have been in recent weeks. But I think it's a learning lesson, because I think there's a lot of newer people out there that suggest that there's no possible way you could make money in the markets in the last couple of months if you're doing bullish trades. And I'm like, yeah, you can. We don't have a single loss during that time period. Now, it's required this 3-day rally that we've had. So to be fair, without that, there would have been some losses here and there. But it is interesting, I think, for newer people to kind of understand that it's not simply the stocks and what they're telling you that dictate your success. Part of it is proper strategy selection as well, and helping yourself understand that options techniques can give you higher probabilities of success if you know how to interpret other things like the VIX and volatility to help you make better decisions as opposed to only trading stocks, right? So there is some value in that conversation there. And obviously, if you don't feel well versed on options trading, we'd love to have you here at Market Scholars as well, where we can kind of whip you into shape. Me on the very beginner level, and then David will really whip you into shape on the multi-legged option strategies, where he gets into some really intense stuff there. But again, check out our subscriptions. We'd love to have you on a premium basis. In terms of other interesting charts here, you can see that the US dollar has had a 3-day give back. Now remember, that one's been a really interesting chart here lately as well. We were talking last week about how we had that big breakout to the upside in the US dollar, and that was somewhat pressuring gold at that time. Remember, dollar was up significantly. Gold really fell apart in a 3-day period right there. Well, notice the opposite is now happening. Dollar has now fallen for 3 straight days, and gold has effectively gone up pretty much for 3 days. Gold was up 0.08% today, so not a big move, but it is helpful for some of you to kind of understand that in-reverse relationship between the US dollar and gold most of the time. Remember, there's a lot of different influences there, so it's never, in a vacuum, but all else being equal, you will tend to see that type of behavior. When the US dollar is strong, all else being equal, gold is weak. When the US dollar is weak, all else being equal, the gold is generally stronger. And so we're kind of seeing that Rorschach test right there, the opposites play out on those two. Now, despite those movements, right, with the dollar coming down 3 days in a row, we still have a strongly bullish posture on the dollar. And the reason for that is there was such an aggressive move above that moving average previously that we can afford to give back a fairly large amount in 3 days and keep the bullish posture because we went up so much to begin with. So the more you go up, the more you can give back and still have that prior posture. Now that won't last forever. So if US dollar falls for the next 2 days and falls below that moving average, I would very much guess that it would turn to a weekly bearish posture at that point. But right now, you kind of have to make the assumption that the dollar kind of got a little bit too big for its britches there, tried to break out, wasn't in the cards. Now you're kind of falling back into that breakout zone there where you have that congestion from where so many other traders were battling back and forth in the UUP over the last, call it 2.5 months or thereabouts. So I've mentioned it so many times, I should probably just do this trade, get it out of the way. But I've been talking about for about 2.5 months now when we have this discussion on the 12 grid that I think gold would have been a good iron condor candidate. And I still think that would have been the case. As you can see, this chart has been largely sideways during that period. So one of these days, it'll actually break out to the upside or to the downside. But right now, I'm just not seeing that it has the conviction to do that. It just kind of seems like it's stuck in no man's land going nowhere. Oil's a different, right? A lot of times you do find that commodities tend to move in unison with one another, but we are in one of those moments right now where that's just simply not the case. Oil and other energy-related commodities have been doing quite well. In fact, some of the agriculture commodities have been doing pretty well here recently too. We actually talked about corn as a commodity in my top-down trend trading class on Monday. So, it's not just the oil world. You actually do have some other commodities that are doing a bit better, but apparently metals, maybe not lighting the world on fire there with gold going kind of sideways. But oil has been doing very, very well. That's what's been fueling that movement of the oil and gas stocks up the chart on the sector selector, right? When oil prices go up, naturally, there's a better chance that the exploration and production companies that extract the oil out of the ground can sell that oil for more and therefore clear greater profit margins as well. Oil was up yet again today. You'll notice here, oil has actually been up 1, 2, 3, 4, 5, 6 sessions in a row. Now, granted, the last 4 sessions, it's gone basically nowhere, so it's gone up by like maybe a penny or two. But there has been some resilience there, right? And that might have been called into the question. We did have 2 out of 3 down days right here on January 20th through January 24th. And some folks might have thought, you know what, oil's gone up too much. It doesn't deserve to go there. Fade that move and go lower. Well, bulls have had another thing to say about that. They've sent it right back to new multi-month highs. So there's been some pretty good strength there out of oil. And I know a lot of people think that there's no future for fossil fuels. And I get it, right? I know the math the same way that you guys do. But the truth of the matter is you can't just turn off fossil fuels. We have to have a transition before we get to all of those electric vehicles and helping our environment and all that sort of thing. And I hope we get there, right? I don't want to see the environment damaged any more than anybody else. But the reality of the situation is there is still economic profits and money to be made in the fossil fuels in certain moments in time. And we're starting to recognize and witness that right before our eyes right now. In terms of some of the other charts up at the top, you will see that the S&P 500, which represents U.S. large cap stocks, foreign developed stocks, represented by EFA, and foreign emerging stocks, represented by EEM, all have a weekly bullish posture now. But there is one difference between those 3 charts, and it is in EEM. And again, given what I just mentioned to you a moment ago about Alibaba finally coming to life for that long call trade that I did, that explains part of the story, right? China is the most important country within the emerging foreign stocks, especially from a market cap perspective. So with a few of those Chinese names moving now, it's really assisted EEM to allow it to really be the first one to be above its moving average. In fact, that's been such an aggressive 3-day move there. Notice the moving average turned green. So we went from a red moving average straight to green. Remember, usually there's a transition, green to yellow to red. Well, this time there was no yellow buffer between the red and the green. We went straight red to straight green because this has been such a rapid move off of the lows in the last 3 days for EEM. So remember, don't just kind of isolate yourself to your home country if you happen to be based here like I am in the United States. There's opportunities all over the world if you're willing to look for them. Let's go ahead and take a look at our sectors now. And on our sectors, that's chart 5C here. As I was mentioning previously, it's really energy and everybody else right now. We've had those conversations, so I'm not going to beat a dead horse, but one way to identify that, obviously, in this particular case, is this is the only dark green chart on the board, right over here on the right-hand side. Now, remember last week, it was the only green chart on the board and all the rest of the sectors were pink. Well, at least now we've got some good news. All of the rest of the sector charts have gone to green, telling us that the intermediate postures have gone to weakly bullish. That's what that light green background color tells us. But when we're in that dark green background color like XLE is here currently, that's telling us that we have a strongly bullish posture on energy. And if you were to look at all these charts and just, eliminate all the labels from the charts, and that way it's not messing with your head, because I know some people are just stubbornly against fossil fuels. I get it. Again, I understand. I'm not here to tell you what you should do morally or ethically or anything like that. I'm here to try to help you interpret charts. And if you're willing to keep your eyes and your ears open towards that, then I think you'll be better off. And I think if you're honest with yourself, regardless of what your mindset is about the environment and about what fossil fuels mean for the future and all that, and if you're just simply looking at the charts themselves and the trends, then I think we would all be in agreement that the best trending chart on the board is clearly this one from energy. And you can also see through the intermediate line reading itself at 93 that it is head and shoulders above everything else on the board. I talked about consumer staples trying to vie for second place. Well, even it is only at about a 35 on the intermediate line. That's approximately where technology is as well. Remember, on the sector selector, as I mentioned before, first of all, it's done on Friday night, so it would not have included the rebounding of the market the last 2 days. But in addition to that, the sector selector is an equal weighted approach. What we're looking at here is a market cap weighted approach, which is a little bit different. So that explains some of the differences there. But even the next best one at this moment, I believe, would be financials at 41. So in other words, intermediate line on energy is 93. Remember, it can't go above 100. So that tells you how close to, quote unquote, perfection you are with energy right now. And the next best one on the board is literally less than half of it, which is the financials at 41. So it truly is the energy world, and the rest of us are just living in it right now when it comes to strength within trends. The rest of them are just grappling with recovering from multi-month downtrends and things like that. So again, great to see that we've got some rebound here. It gives us the impression that market participants aren't just going to roll over and play dead and just let the bears have their way. There is some bullishness that has emerged in recent days, and there has been some bottom pickers and some folks that felt like the selling had gotten too extreme, and some opportunities to pick up higher quality companies when they got a little cheaper. So it is good to see that behavior in the market. But if you're looking for true, absolute, and relative strength out there right now, you're probably going to have to look in the oil patch. And that is what we ended up doing Monday in class, adding a well-regarded oil field services company to our top-down trend trading class in that premium class that I teach there. I'm now going to come on over here to a one grid chart 4A for the market forecast itself, and I'm going to pull up ticker symbol BA, and this is Boeing. Now, Boeing, obviously well-known company, right? It's one of the largest airplane manufacturers on the planet. It also had its stumbling blocks even before the coronavirus. We've seen Airbus struggle, of course, in Europe as well during the coronavirus, as there's a lot more people that are choosing not to travel on airplanes during this era. But Airbus wasn't having the struggles that Boeing was before that. So Boeing's kind of been out of favor for a longer stretch of time. Now, how that shakes out longer term is anybody's guess. I still tend to think it's a pretty decent company. Obviously not thrilled with, some of the challenges they've had with the manufacturing of their airlines, and I do hope that for everybody's sake, society's sake, that they get better as time goes on. But I don't necessarily think Boeing is heading for disaster at the same time. Right now, what this chart tells me is bears or bulls can't really make up their mind. You have moments during the last 3 months where Boeing looked like it was really going to fall out of favor with market participants. And those would have been times like back here in late November. You also had some ugly trading here in mid-December, and then you had this big sell-off along with the rest of the market in the last few weeks in January here. But you'll also notice that the bulls didn't exactly just give up and say, okay, you're right, bears, take over the chart. The bulls were resilient. You just needed to press them into that resilience. And you'll notice that there's a triple bottom here on Boeing that occurred, first of all, when we got that oversold cluster signal on December 1st. And then again, it tested that area on December 20th. And then again here at the bottom here just 3 trading sessions ago, where you flushed the toilet, so to speak, got rid of all those people that might have had their stop losses slightly below those prior 2 candles, and then whipped that trade right back up to close basically at the highs of the session. And notice we've also closed at the highs of the session in the following 2 days as well, including today. With today's move, notice that the background color went back from bearish to now weekly bullish, and notice that the moving average color turned to green because this has been such a robust move. It's kind of like the emerging markets, as a matter of fact, where you had a really aggressive 3-day move, and you're right back to a green moving average. There you did have 1 day of a yellow transition, but for the most part, they've done a pretty good job unwinding that really extreme bearishness. Now, where we ended today, again, remember when we were looking at the heat map before, Boeing was one of the best performers today. But notice where we're at in the chart from the grand scheme of things, kind of taking that 10,000-foot view of the company or the stock chart now. And despite this really good day that it had today, following 2 really other good days prior to that, where we are right now is exactly in the middle of the range. If you were to look at this and basically split the difference from about 234 at its high back here on November 15th and 184 at its low right here, the middle of those 2 numbers is basically $209, or approximately where we're trading right now. So isn't that kind of crazy that, we've had what appears to be kind of erratic trading all over the place. But what it's resulted in is a stock that's traded exactly in the middle of its range as we speak. And when we see trades like that, my first mindset is iron condor. Now, I do want to make sure that volatility is a little bit higher, or at least in an ideal world, I'd like to see volatility a little bit higher with the hopes that volatility settles in a little bit. And we do have somewhat higher volatility still, despite the 3-day rally. So I think this is a reasonably good condition to be selling an iron condor in. Now, for those of you that are newer to the idea of selling iron condors, what you're hoping for in a trade like this is for the stock to not really go anywhere between now and expiration date. I think on these ones, I selected the March monthly contracts. Remember, the trade was already done during the normal market session. I've sent out the trade alerts to all of you that are premium members on the Telegram app, so you've already had access to it. And you can see I've also plotted my break-even lines on the trade. So these black dotted lines here represent where my break-evens are. What makes the iron condor somewhat unique is that you have 2 break-even lines. And that is both good and bad. It depends upon your mindset there. On the one hand, it's good because you earn 2 different credits, right? You've probably seen us do just normal selling a bull put spread as a one-off trade or selling a bear call spread as a one-off trade. An iron condor is effectively combining those 2 things into the same trade on the same underlying security with the same expiration date. And so you have 2 different credits that are coming into your account, which is cool. On the flip side, you also have 2 different places where you could go wrong, right? Sometimes you get lucky and you might think a stock is going to go sideways and it goes up a little bit when you're doing a bear call spread, but because you gave yourself enough wiggle room, you were able to get out of it. So there's different things that you can think about there, but there's only one break even that you need to concentrate on. Now we've got 2 different worry zones, right? On something like this. Our worry zone to the upside is up here at 236.29, and our worry to the downside is down here at 178.71. So you have 2 different areas where things could go wrong. Now, by giving yourself enough wiggle room, and what we tend to concentrate on is selling the 20 deltas here, as long as we can still get at least a 30% return on risk. And that's what I've done in this particular case. What I kind of liked about this example is that my break evens are on both the upside above the highest price that this plotted in the last 3 months. So you can see prior, the highest price was 233.94. So in order for me to get in hot water with this trade, it would have to go up to 236.29 or higher. In other words, it would have to break out to new highs between now and the middle of March. Or on the flip side, where I get into hot water on the downside, is if we were to break down below the low that this just plotted here a few trading sessions ago down at 183.77. It would have to fall about $5 further below that moment. So if we have choppy conditions going forward, but those choppy conditions kind of represent the same style that Boeing has had for investors or traders in the last 3 months, we should be reasonably good on this trade setup. Obviously, if this turns from a sideways chart into a directional chart, either to the upside or the downside, we will end up losing money on that. But remember, the nice thing about an iron condor trade is that you have defined risk. So if you had a really massive move, now note that they've already reported their earnings, so we're not going to see a big gap up or down on earnings for Boeing specifically between now and the middle of March. But there could be some other big news event, right? One of their airplanes, unfortunately, could get damaged or fall out of the sky or whatever, and the stock market could punish it accordingly. So we have to remind ourselves that that type of thing is possible. And the nice thing about an iron condor is that part of the trade is embedding hedges within the trade structure itself because there's 4 different strikes. So we do know what our worst case is going into the trade. And, these are $5 wide iron condor spreads that I'm selling here. So our worst case scenario that would be that we'd lose like $350 or something like that on a one contract trade. Ideally, that's not going to happen, right? But I'm just saying that if something crazy happens out of the blue and this chart turns into a directional one, then we have to, be okay with that. And one of the ways to be okay with it is understanding that you have defined risk here. But, obviously, if we have somewhat similar trading in the next month and a half as we've had in the last 3 months, then this should be a winnable trade. Ideally, I'd like to think that in the next month and a half, trading will actually be less aggressive, right? And that would actually benefit us more because the less aggressive the trading is going forward compared to the past, the less there's a chance that it's going to break dramatically higher above this black line on the top or break dramatically lower on this black line on the bottom. Okay, so that's what I had for you for tonight's trade application example. Again, as I mentioned earlier in the session, you can kind of read through the lines there, right? With a lot of my trades more recently being bullish trades, this one is not considered a bullish trade. This is a neutral trade with the recognition we have now had a bullish bounce. We've got to be a little bit more cautious and anticipatory towards the possibility of sellers taking control of this market again at some point in the coming weeks. And an iron condor can successfully be implemented in that type of market environment. And if we do get more of an obvious rollover, let's say next week, I might very well do a more purely bearish trade at that time. So we'll keep our eye on the ball there for you. Again, if you appreciate these longer form videos where you get to learn from application of the trade examples at the end, I ask one simple thing out of you. Simply click like for us there on Twitter. As long as we're getting up and over 100 likes, at least we can somewhat justify the amount of time that goes into creating these videos for you as regularly as we do. So do your best on that. We'll do our best for you on the flip side. David should be back in the saddle for you tomorrow, and then I'll see many of you on Thursday back in the Market Outlook video. For you premium members, I'll see you tomorrow morning in my factor-based swing trading class. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.